with a growth estimate of 5.7%, we expect it to be majorly driven by services. Services account to 45% of the overall nominal GDP. And looking at the recent performance, you've seen it, that's the one which has been having some steady growth. We expect it to remain the same even in the course of this year. Agriculture, which accounts for 34% of the overall GDP, we expect some turbulence in the short-term horizon. Back on the spillover of the erratic rainfall that we saw November, December period, and also on expectations of there could be a bit of minimal rainfall coming the March to the May long rain period. So we expect some erraticities, erratic weather patterns, which will also impact on agriculture. Bottom line also, on the risks to the growth, majorly we're looking at escalated political noise in the year. Of course, with the talks about BBI referendum, and it could have a major impact on the services, which most of the sectors under services are domestically oriented sectors. So if there's some escalation in political noise, it could also have an impact in the services segment here. That's on the supply side. And what you look at on the demand side, the private consumption is still muted. There's still not much demand pressures in the economy. So that's why broadly we are a bit on the lower end of the projections vis-a-vis Treasury CBK. Of course, from where CBK is coming from, it's looking at that revival in the private sector credit growth, and there's usually a positive correlation in terms of the credit growth to the private sector and the GDP. And from where we sit, even in our in-house view, we see that, yes, perhaps there's that stimulant towards credit growth being sent to the private sector, but it could not be as, the actual numbers may not be as optimistic as where CBK is sitting in, because there are still some fragilities in the economy. And just to give it some context, and the estimate for CBK for private sector credit growth was 11.3% as of December, but it came to 7.1%. So they're still showing that, yes, one, repeal of the rate cap happened in early November, but there's still not much of a demand by the private sector to the credit. So yes, one issue about it is there's still some, it's like a window for private sector to have increased borrowing, but the appetite might not even be there. So just speaking about the sector, the private sector, the business environment that they're operating might not be conducive for them even to get that appetite for borrowing. And even looking at the consumption, private consumption consumes around 78% of the gross domestic expenditure. So, but just looking at some of the indicators that are coming out, core inflation has been quite muted, and pending bills is still an issue. So you find that, well, because of the underlying business environment, challenging business environment, you find that they might not necessarily be that demand. So unless some of the issues are addressed, that's when you can see some uptick in private. We've seen some positive strides being made on the pending bills. At least there's been a narrowing in the pending bills from highs of, I don't know, close to 200 billion. Right now, I think looking at around, is it 60 billion in terms of both the national government and the county governments. So there's been that reduction in the pending bills. So there'll be liquidity in the system, and then we could see even there'll be appetite for credit. That's one. And of course, there's never a silver bullet towards it. So what could affect an individual might not necessarily affect a firm. And what we are seeing, what has had a negative impact with the individuals. Just looking at stories, news flows has been awash on layoffs by some of the private sector firms, and also most of the properties being auctioned. So it's just speaking to, on an individual level, there's depressed disposable income. So, but at least there's still some mechanisms in place which are being put on a macro level, at least with that repeal of the rate cap. Firms may start having a bit of, the business environment might be quite leveled. And after it, it could have an impact even on the individuals. So at least there's still some steps being made in the right direction. Okay. CBK needs to come out quite clear, even in terms of its communication, because the market is quite in a confused mode. And one, perhaps that CBK November MPC meeting, the rate cut was ostensibly, let me just qualify it, ostensibly in place so that because there was a fiscal consolidation that had been touted by National Treasury. But by and large, you don't see that fiscal consolidation happening from the fact that even supplementary budget had an increase in expenditure. So it's a bit of a conflict even there. So, and even looking at the yields, the movement in yields, it just speaks to the fact that there's some borrowing pressure by government, by Treasury on one hand, so as at least to attract investors towards this, the T-bills, the T-bonds here. So that's one. So that's what the market is even looking at, even in the first half period of this year. Then the CBR, the cut, I think is addressing the fact that now even the real economy, there are still some stresses. What we had alluded to earlier, private sector credit growth not hitting the targeted level of 11.3%. And just most of the focus of CBK is just to look at price stability. Of course, the headline numbers are quite erratic. We still expect in the short term it could flare up because of the food inflation, the food supply shocks. But nonetheless, if you look at the core inflation, is still muted, just showing how the real economy is still not quite solid to support growth. So to me, I see that rate cut that came was now addressing the real economy. That, okay, that 50 basis point cut in November perhaps did not fully entice the private sector come to start borrow. So why should we not increase it further by 25 basis points? And that perhaps what came out to me loud and clear with that rate decision that was that came out on Monday. It's quite confusing. It's quite a confused mode. But by and large, now people will just be looking at now, for instance, in the capital market, people will just be looking at it on terms of the borrowing as CBK comes in to just looking at it case by case. And even in the banks, what you've been seeing, even most of them are even split. With the rate cap, with the repeal of the rate cap, it was a given by most people that now banks will start lending, but that anecdotal evidence is that is not the case. You find that now, okay, even banks are not, they're trying to get some pricing mechanism. The lending is not as robust as expected. So they are also still funding the government when it comes with be it T-bills, be it T-bonds, rather than lending to the private sector. So it's still a wait, and just the market participants rather will just try to let this whole noise to clear out and then start responding accordingly. That's my view, short-term view. There's that gradual uptick in private sector credit growth, the rate of the growth itself. But now come this year, we'll see what we call the base effect. That yes, if last year we saw between the months of May to December upwards of 5% to 7%. So this year we could expect the base effect now because it's on a higher quantum. So it will now be able, we'll see some sort of downward revision. So the base effect, so it happens here. So the double-digit growth, it could be now if banks now start, you could see actual that banks are now starting to lend to the market and in significant amount for us to be convinced that yes, this is where the double-digit growth will be coming to. So perhaps next year or late this year is when we can now see it starting to pick up. Yeah, our estimate is the borrowing for this year will be 7.5 billion, of which 25 billion. Yeah, that's also inclusive after the supplementary budget adjustments. And the split will work this way. On the external side, 330 billion, and on the domestic side, 395 billion. That's the split between now external and the domestic borrowing in the financial year. So it's heavily skewed on the domestic side rather than on the external side. But initially that wasn't the case because the initial target was 330 billion on the external and 300 billion on the domestic. But because of the supplementary budget, it was heavily skewed to the domestic side here. And what we are seeing on the external side, let me just focus on the external side first. There's that bit of commercial financing, which is around 213 billion. Just to give it some splits, there's 13 billion export credit, and then there's 200 billion now, which traditionally goes to the syndicated loans and the Eurobonds. But from Treasury's recent announcements is that now there'll be a skew towards concessional funding rather than the commercial financing here. So, and what we've heard, this 200 billion could be this way. Rather than going to the Eurobond syndicated loans, it will now see there'll be a World Bank facility around 100 billion from what I read 2 weeks ago, and that could be, rather than commercial financing, it will now go to the project. It could now be budget support. Yeah, and then there's another one for 100 billion, which even the governor alluded to yesterday during the post-MPC briefing, a sovereign green bond issuance. Yeah, which is different from the Econ that was dual listed in LSE. So to me, it's just showing that, okay, it's now, rather than going to the traditional Eurobonds syndicated, there's some element of now trying to tilt it away from those two Eurobonds and the syndicated loans here. And to me, the question easily comes because you see with green bonds, there could be some projects, underlying projects, which are quite specific. In our books, now the question is, do we have those kind of projects to be financed by the green bond, say Eurobond issuance? Yeah. That's a question that now Treasury now has to come back to us and be quite clear about it, because that's what even ideally green bond is. This project which is towards a green project, and we are raising a green bond to fund this project. Do we have any? Jury is out. That's with the external financing. Coming to the domestic financing, 391 billion. I'm looking at historically there's usually been a split that 30% from T-bills, 70% from T-bonds, and what we have been seeing even the first half of the current financial year, with the increased issuance of longer term papers, there's not been much of a demand. So perhaps you could see with the medium term debt management strategy, which is expected to come out mid-February, it could be biased towards medium term papers. At least that they could be able to, there's an opportunity to be able to meet the demand from Treasury perspective, yeah. And could see there could be an increase in yields as now Treasury now starts taking up, accepting the bids, at least to even match the quantum for the year. So that's pretty much my outlook.